This is your daily real estate syndication show, and I'm your host, Whitney Sewell. Today is a highlight show that's packed with value from different guests around a specific topic. Don't forget to like and subscribe, but also go to lifebridgecapital.com where you can sign up to start investing in real estate today. I hope you enjoy the show. Our guest is Debbie Bloyd. Thanks for being on the show, Debbie.
Hi, thanks so much for having me.
Okay, let's focus on that a little bit as far as an investor, looking for their first deal or types of financing that they should be thinking about right now. And I know lots of listeners are still, they're looking for that first deal, and they're wanting, that first deal is so important, and financing is such a big piece of it. I know, financing can just make or break a deal, right? I mean, depending on what type of financing.
Yeah. So I'm an investor myself. So I buy and flip properties, and I buy properties and I've held them. And right now I took out a hard money loan a couple years ago to buy a little house, and we tore off the roof. We added an extra 1,500 square feet, and now it's up for sale. It's almost finished. And that was a hard money loan. So those rates are going to be in the 9s. You take what you can get, and there's a lot of different ways to do it. There's a construction loan that you can get. There is you just buy a regular loan, a 30-year fixed rate mortgage on a duplex or a fourplex or a single family. And then you're going to need your cash to make improvements. There is one loan out there. The thing is, if you're an investor, you don't buy it as your primary. And FHA has a loan product that you can do some rehab on, but you have to have it as your primary. So if I know a lot of people build up their investment portfolio by going house to house to house as their primary. So you buy something, you move in it, you fix it up, then you sell it, and you do it all again. That way you're always borrowing money, at least at the lowest rates.
Okay. So can you speak to that construction loan a little bit? I think that's a popular thing that people need when they're getting into the business. But then you mentioned, you need your cash to make improvements. And tell me a little bit, or let's talk about that just a little bit.
Sure. So FHA has a program at 203K, I believe it is. I don't do that many of them because their requirements are kind of hard. So if you buy an FHA house, it has to be a primary, and you have to call it your primary. So you've got to live there. And a lot of people don't like to do construction loans when they live there.
Is there a certain length of time you have to live there?
No, but you just have to buy it as your primary. So you have to either take whatever you're living in now and call it an investment and move there. FHA is pretty tough. They're going to make sure you're going to change your address and do your stuff, that you're really moving in there. And then you have to provide them, when you first get the loan, you have to also provide them with a set of plans and what are you going to do to it. If it's just lipstick, if it's just wallpaper, paint, new cabinets, you've got to have an estimate, and they have to approve that estimate. It has to come from a real builder that they can vet. So the problem for most of my clients is if they buy a house like that, they're going to fix it up themselves. And this loan doesn't allow for that. So you'd have to hire a contractor. They'd have to have insurance. And so it's a bigger process. Most of my people that want to buy a house, live in it, and fix it up and flip it, they want to do all the work themselves. And so they simply can't qualify.
Okay. So what about, multifamily properties, or, something, if I'm looking at, say, a 4- or 5-plex, I know, one's going to be residential, one's going to be commercial, maybe you could let's talk about that.
Yeah. So if you buy a 4-plex, you can still buy a 4-plex on a one-time, like a primary. If you're going to live in one of the units and you're going to renovate the other ones, if you buy it strictly as an investment, the way it works is you buy the property, you're putting 25% down at current date. With COVID, it's really put a kibosh on a lot of transactions, because what used to be 20% down is now 25. What used to be a 680 credit score is now 700, or what we used to get into houses at 620. And a lot of lenders have upped their FHA loans to 640. But as a broker, I'm signed up with a lot of different companies, so I can still go down in the 5s. They're just called Alt-A loans, and not every bank has them. I had a client in last week that she was denied at one of the bigger banks, and it was because her score was 613. But I can do those all day long. So you just have to know where to look. If you buy a 4-plex and you put your 25% down, you're going to need to also have money set aside for the construction of it, the improvements. Remember, you're going to do that after you buy it, and there is really not a way to roll that into the loan. So you either have to have an equity line of credit at your bank, or you have to have the cash to do it. So right now, of course, cash is king. So if you have cash, then you can do it yourself. You can hire subcontractors that aren't licensed. But if you are putting that into some type of loan that a bank has to approve, everybody has to be approved. So it's really cash is what you're using to fix it up.
So what happens then if we are going to finance a five-plex, or something larger? How's that loan change?
So a commercial loan right now, a lot of them are asking for 30% down instead of the 20% down they used to. And they have to have, your investors have to have financials. So yes, you can buy it as a person, but you can also buy it as an LLC. If you're if you've made an LLC, that's a commercial loan. Anything over a 4 unit is a commercial loan. So they also vet your company. Certain banks don't require any seasoning on your LLC, and you have to have money in your LLC. So that means when you're first setting up the company, you're going to deposit money in that account for the LLC, and they're going to have to see money in there to make you legit. And then they go on vetting you. So they have to see, are you the primary sole contributor and owner of the LLC, or are there other people in play? I've got a lot of clients that have gone in with siblings or business associates, and they make an LLC. They all throw money in the pot, and they think that LLC is going to be able to survive on its own merit because it's brand new. No, they've got to pull financials from all 4 people or all 2 people, whoever makes up the LLC, because if LLC is less than 2 years old, they want financials on everybody. It's got no track record. So I'm afraid that most investors don't know all these things. They get all excited to buy a property, and then they find out that they haven't had the company long enough, and they have to go hard money at that point.
So could we buy it, say, on contract with an established entity, and then have a new entity that we put that property in when we close?
No, it has to be vetted. So if it goes through the bank, you can't flip it. You can only flip a property. So like you can buy it. What most of my deals go, it's their personal name, and they buy it as an investment property, but they're just stopping at fourplexes. They're not ever doing commercial stuff, because once you stay commercial, you have to stay commercial. Once you buy it as an individual, like I could buy something as Debbie, and then when I close and it funds and I own it now, I can, on paper, move it into an LLC. So the liability goes into the LLC, but the LLC has no track record. It has no money in it. It's just kind of an empty shell. So I have to buy it in my personal name. You get a much better interest rate when you buy in your personal name. Commercial loans can be 5% and 6%. When you buy something like a fourplex in your personal name, you're down at 4%. Underwriting is much easier. So people buy it. You've got to be a real established LLC to buy commercially. And most people don't know that. So they just start out the paperwork and they think they fund it. They put $100,000 in the account. They're good to go. No, they've got to have a track record.
What does that track record look like? What does that consist of? Is it just doing numerous deals, or, It's having money in the bank. It's having them pay rent. It's having rental checks come into that bank account. It's to show that they're real, that it's just not a front for something else. So I think half of the legitimacy is not money laundering, and the other half is just knowing that they have the money behind it. So the more properties you buy, the more you have to have in savings in a 401k or an IRA or cash to qualify. So you always have to show with your rental properties that you've got 6 months of principal, interest, taxes, and insurance for every property. So it's easy for the first one. The second one, it gets a little tougher. And by the time you've got 10 properties, you've got to have a lot of cash behind you, or you don't get to buy the next one, because it all adds up every step of the way. You've got to have 6 months of every single rental you have saved up. Not that you have to have it liquid, but you have to have it. It can be invested in mutual funds or an IRA, but you still have to have it somewhere that they can see it, so that if something happened like this, which no one ever thought would happen, this pandemic, people can't pay rent. How many months can you go and float without being bankrupt yourself? If you have no cushion, you're going to go under yourself. So the banks have added those requirements ongoing just to make sure you have enough and you don't turn upside down. Our guest is Eric Johnson. Thanks for being on the show, Eric.
Hey, Whitney. Thanks for having me. Good morning.
So why don't we talk a little bit about just, debt strategies and just how they align with different types of investment niches?
Yeah, absolutely. So I'll try to make this super concise and just super digestible. If we're just talking in, investor financing here, I mean, let's look at the main strategies, right? You have fix and refi, or we fix, refi, and hold, which is, essentially BRRRR, right? And then you also have 5+. So 5+ units or multifamily. And at that point, it's a different game in terms of the debt. So let's tackle the fix and sell and fix and hold, since that's probably what 90% of investors are doing, right? On 1 to 4 unit. That's the asset. So for fix and sell, right, you have essentially fix and flip loans, right? That's short-term bridge lending. That's a percentage of the acquisition, and you get your construction, right? That's what enables you to do deals. And then whether you external investors for the equity piece is kind of, it's a non-factor, but that's where the debt is coming from, right? So if you're an investor who wants to flip, that's what it is. It's a probably 12-month bridge loan, 80% acquisition, 100% construction, and then that's what keeps your business, rolling from a debt perspective. For a fix and refi, so for a BRRRR deal, you're going to have 2 pieces, and this is why it's a little more complicated than just a fix and flip, because a fix and flip only has one debt, what I call stage, right? For any deal that has a refi, you have 2 debt stages, right? You have the initial front end, which is the acquisition, which will still be a bridge loan, right? Because you still need to fix the property. And on the refi side, now you need to make sure that your LTVs line up with your payoff and the market value of the property, right? So on the refi side, you're going to be looking at probably, if you're an investor who can't go conventional, probably an asset-based commercial loan, right? Based on the debt coverage ratio of the property. And that's going to be the 2 debt stages for BRRRR deals. And I advise investors keep your ARV or keep your payoff to 70% of your ARV. Some people push it to 75. I don't usually like to advise on 75, just because it can be tougher. It can eliminate some of your options, especially with a situation like COVID. If a shift in the marketplace happens, you want to make sure you're protected. But roughly that's kind of, if you're a smaller investor on 1 to 4 unit properties, those are your kind of your end games for debt.
Yeah.
Just a very brief overview. Yeah.
Yeah. And I think most of the listeners are going to be doing the 5 units or more. They're going to be in larger commercial real estate, and looking for, obviously the agency debt or bridge debt for larger properties or different things like that. What about as they are looking for debt right now, just with COVID and everything that's happened? Could you just speak to that listener right now who's trying to get into to the syndication business? They're looking for debt. What are their challenges going to be right now in the current market with COVID, everything that's happening?
Yeah, absolutely. If you're a syndicator, if you're experienced or syndicator listening, there's a lot of moving parts right now. One is leverage in the marketplace has significantly decreased because secondary market investors are really skittish and therefore reducing liquidity in the secondary market. So where those dollars were really flowing, pre-COVID, they're not. It really, even Freddie and Fannie are at 75 and they were 80% all day, before COVID. So you need to be careful on what leverage you're anticipating. And then the second part is how you're structuring your deals from an investor standpoint, and making sure that that's clear, especially in a saturated like this. I know a lot of my clients they're not winning deals. They're submitting offers and there's just 4 other offers on the property, especially for multifamily. And so going back to the entity structure, making sure you have all of your LPs and external investors in line, making sure that deal structure is clear from the beginning. So there's no time wasted, because depending on that structure and how you set up your entity and how you set up your investors within that entity, usually single asset entity, then it'll play into the underwriting of the deal, and you may need to switch some things. That's why it's the best idea to get it sorted out at the beginning. And I see a lot of syndicators run into that issue where they're scrambling, trying to figure out their LP or their investor structure, just because, there's some things that came up in the process, which is normal. But I mean, that's why you need to stay flexible.
So let's talk about those a little bit. You talked about how leverage has decreased, and how Freddie and Fannie are now at 75%. What will that typically do to a deal? Is that going to kill, most deals? How do you see that on the lending side? What are those barriers and how do we overcome them?
Yeah. So I wouldn't say the 5% knack in leverage is in and of itself a deal killer, right? Because you can still just raise that 5% equity. Like that's not a big issue. Really, the issue is even on agency debt right now, there's COVID reserves, right? So that's the big thing. So before, obviously pre-COVID, there was no such thing as COVID reserves. Usually, you have your net worth, your liquidity requirements, but right now they're actually having, sponsors escrow maybe 6 months of P&I in addition to cash to close. So the borrowers are coming in with pretty much, more equity. And in some cases can be 9 months. And I know as of a couple months ago, it was PITI as well, 6 months PITI. And then some people are like, well, depending on the size of the deal, right? If it's a large loan amount, that could be a decent sum of money. So, people, sponsors were kind of backing off and they're like, oh, this deal is not too good. So they kind of pulled the plug. But as far as rates go, I mean, obviously great rates, but it's just, getting over those reserve requirements. So that's really another key thing that if you're a syndicator in this market and you want to do deals, just expect some kind of additional liquidity, or, reserve requirements. On top of, everything.
What's been the process or what you've seen up to this point of getting those reserves back?
Really, it's going to be the agencies are essentially holding that in an escrow account, right? And from what information that they've put out actually publicly is when the COVID reserves kind of back off, the sponsors are going to have to request those funds back. So if it was a COVID specific escrow account or requirements of, for the loan in the loan docs at funding, when those are, backed off in the future, whenever that is, then the sponsors are going to have to go back and, essentially reach out and say, hey, my property is operating at, 95% occupancy. We're good. The COVID, guidelines have backed off. I would like to request my funds back from this specific account. And that's usually how you would do it. That's the most direct way.
Okay. So we got to go, we got to request that. And I like how you mentioned there, present ourselves well. This is the property's operating this well. This is what's happened over the last year. This is our occupancy, all those things. So we can just bolster why they should refund the reserves, right? Or give those back to us so we can use those or distribute them back out to investors as well. If it's, if we didn't need that at the moment. And so you talked also about the importance of structuring the deal correctly and clear from the beginning. Could you elaborate on that? What does that mean exactly to the lender, as far as, structuring it clear from the beginning?
Yeah, it's going to depend on which program, I guess the asset or the deal falls into, right? Because obviously if you're going to go, something like agency versus CMBS is a little more lax, I guess is the right word, right? And that's usually the tier below, something like agency. Agency is going to be more strict. You're going to have to follow, all, what they require, and usually it's a single asset entity, and if you have outside, you usually have an LLC just for holding the investors, right? So you don't usually put yourself in, as a member of the LLC. And then slap in your 20 investors as members. You usually have, one LLC that's maybe you and another general partner, and then you have another LLC in which all of the other LPs are in, and then the LLC that you and your other general partner are in own. That it's contained within that. The LP LLC is contained within the GP LLC, so to say, but the GP LLC is the title holder. So that's generally a clean, acceptable way to do it. Obviously, it's going to depend, but that's a pretty clean way to just keep everything nice and in its own separate domain, so to say. So there's no crossover confusion.
What are a couple ways that you've seen people get creative with lending to just help explode their growth?
Really value add, right? So syndicators are all about value add. So in my experience in funding these deals, really it's going after bridge debt at the beginning. So if the sponsor really identifies a good value add asset and there's a lot of potential for upside, you can definitely come in with a bridge loan at 75 LTV and maybe 100% construction, right? So it's essentially going to be like it's going to be like a Burr deal, but for multifamily, if you want to think of it like that, right? You're essentially fixing it, rehabbing it, stabilizing it, and refinancing. So if you're a syndicator listening to this, if you can really use bridge debt creatively in addition to an equity raise, right? And by putting those two together, you can really come into a deal very strong. And by the time that you fix up the property and hopefully underwrite conservatively, you still have a lot of upside to capture. But once the property is stabilized, once you refi and hold it, you should be able to capitalize on even a cash out refi and disperse some of that equity back, and obviously lower your rate and get better terms on it. So, but again, on the value add side, still going to be probably a 12 to 24 month bridge loan, depending on how big the project is, right? If it's a 50 unit building and needs $1 million in capex, then we'll probably shoot for a 24-month initial plus, some 6-month extensions here and there.
Thank you for being a loyal listener of the show. Please subscribe and share it with your friends. We want to help you become the passive investor you've always wanted to become, but also the operator you've always wanted to become. We want to be the number one resource for your real estate investing journey. But go to lifebridgecapital.com where you can start investing in real estate today.